Ever wondered where companies get the money to grow, or where you can invest for the long term versus a quick, safe return? It all comes down to understanding the difference between capital markets and money markets. These aren't just Wall Street jargon. They're fundamental to the U.S. economy and impact everything from home loans to business expansion, and ultimately, your investments. Let's start with the money market. Think of it as the short-term lending and borrowing hub. We're talking about loans that mature in a year or less. It's where businesses and governments go to cover immediate cash flow needs, things like payroll, inventory, or bridging the gap between receiving payments. For you, the investor, money markets offer incredibly safe, but generally low-return options. Think of a Treasury bill or T-bill. The U.S. government sells these to raise short-term funds. You buy it at a discount, and when it matures, you get the face value. It's practically risk-free, backed by the full faith and credit of the U.S. government. Similarly, commercial paper are short-term, unsecured promissory notes issued by corporations. They're a way for companies to finance short-term liabilities. Money market mutual funds pool money from many investors to invest in these short-term debt securities, offering diversification and liquidity. Another example, repurchase agreements or repos. This is where one party sells a security to another with an agreement to repurchase it at a higher price on a specific date. It's essentially a short-term collateralized loan. The key takeaway with money markets is liquidity and safety. You can easily access your money, and the risk of losing your principal is very low. But because of this safety, the returns are generally lower than other investment options. Now let's shift gears to capital markets. This is where the long-term financing happens. We're talking about investments that mature in more than a year, often many years. This is where companies raise money to fund major projects, building a new factory, developing a new product, or expanding into new markets. The two main types of capital markets are the stock market and the bond market. Let's start with the stock market. When you buy a share of stock, you're buying a piece of ownership in a company. The company uses the money from the sale of stock to fund its operations and growth. The potential for return is much higher in the stock market than in the money market, but so is the risk. Stock prices can fluctuate significantly based on company performance, economic conditions, and investor sentiment. Then there's the bond market. Bonds are essentially loans that you make to a company or government. In return, they promise to pay you back the principal amount plus interest over a specific period. Bonds are generally considered less risky than stocks, but they also offer lower potential returns. Corporate bonds are issued by companies, while government bonds are issued by federal, state, and local governments. Let's look at a simple example. Imagine a tech startup, Innovate Corp, wants to build a new research facility. They could issue bonds promising to pay investors back with interest over 10 years. Or they could issue stock, giving investors a share of ownership in the company. Both options allow Innovate Corp to raise the capital they need, but they appeal to different types of investors. Someone wanting a predictable income stream might prefer the bonds, while someone seeking higher growth potential might prefer the stock. So what are the key differences summarized? Money markets deal with short-term debt, less than a year, focusing on liquidity and safety. Think T-bills, commercial paper, and money market funds. Capital markets deal with long-term debt and equity, more than a year, focusing on growth and long-term returns. Think stocks, corporate bonds, and government bonds. Think of it this way. If a company needs money to pay its bills next month, it goes to the money market. If it needs money to build a new factory next year, it goes to the capital market. For you as an investor, understanding this difference is crucial. Money markets are good for preserving capital and having easy access to your funds. Capital markets are good for growing your wealth over the long term, but with more risk. A well-diversified portfolio often includes both money market and capital market investments. Money market funds can provide stability and liquidity, while stocks and bonds can offer the potential for higher returns. The right mix depends on your individual financial goals, risk tolerance, and time horizon. Both markets are vital to a healthy economy. They facilitate the flow of funds from savers to borrowers, enabling businesses to grow, creating jobs, and driving innovation. Understanding these markets empowers you to make informed investment decisions and participate in the financial system effectively. Remember, this information is for educational purposes only and should not be taken as financial advice. Always consult with a qualified financial professional before making investment decisions.